Hello there guys and welcome back. So let's talk about the best ETFs on the market today. I did a video on the SCHD equivalent ETFs in the UK out there and you all seem to like it. So I thought I'd maybe cover the best ones specifically on Trading 212 also in the UK. So I've gone through tons of ETFs, literally hundreds on Trading 212 and settled on the top 3 in my opinion to get you the best overall returns and not get charged an arm and a leg to invest in them. I'll cover these ETFs' past returns, composition, what sort of fees that they charge, and lots more. Everything you'll need to know, you'll be able to find here. So let's get started. Now we are looking specifically ones held on Trading 212 because if you're like me, I like having all my investments held on just that one app and watch it grow, etc. But it can actually be a bit of a minefield in which ones to choose. Should you invest in the UK or the US economy, or maybe even a European economy? Should you focus on dividend yielding ETFs or have a highly diversified ETF that invests in thousands of companies? Well, let's find out. To kick it off with one that allows you to invest in the world as a whole. Just quickly, none of this is financial advice, so please be careful when investing. Now this one is a set and forget kind of ETF and has amazing diversity across American markets and the rest of the world. The Vanguard All World UCI TS ETF or VWRP invests in 3,000 plus stocks. Now whether you choose the accumulative or dividend paying ETF, this one produces impressive returns over the past year, up 18% this year alone, and is generally a well-regarded ETF held through Vanguard and available on Trading 212. If I was looking to invest and forget entirely about my investments for long periods of time, this would probably be the one I would go for. Now there are a few things to know about this one before investing in it. The weighting, whilst described as an all-world ETF, is heavily weighted towards North America, with America's largest companies taking up over 62% of this fund. Europe follows closely afterwards, taking up 15%, and Pacific countries like Japan taking up over 10%. And that finally leaves just around 9% taken up by emerging markets. Personally, this allocation may seem skewed towards America, but the excellent thing about this ETF over others is the weighting changes with time. For example, the weighting of the UK market as a part of this fund used to be higher than it currently is, because the economy in the UK has been struggling with companies having smaller market caps and therefore less weighting in this ETF. Contrastingly, Japan's economy stocks have made a comeback in more recent times and established over 6% of this fund more recently. The reason this is amazing and very handy to have for your investments is if overnight the Chinese or Japanese economy explodes, then this fund would gain you a piece of the action. With the innovation that comes from these areas in the Pacific and other areas around the world, I think it is one of the ideal start points to invest in the world as a whole and diversifying almost completely. If we look at the weighting on an industry level, we can see heavy weighting towards technology at over 26%. Now that's not as high as the S&P 500, which sits at over 29%, but it's still on the higher end. And if you wanted to avoid technology-based American companies, then this one still has high exposure to them despite the name. Additionally, the fees, whilst manageable, are higher than some other funds at 0.22%. I would say the ideal person to invest in something like this is someone that leaves their investments alone and doesn't want to look at individual companies, wants some exposure to the rest of the world without being completely reliant on America. The biggest holding in terms of individual companies, for those that wish to know, are Microsoft at over 4%, Apple over 3%, and Amazon and Nvidia holding just over 2%. With over 3,700 holdings, this one is a level of diversification you really don't see in other ETFs or anyone else for that matter. Now moving along to one of our second choices, and if I'm honest, I've cheated with this one because this ETF is more like two ETFs with how you would like to lay it out if you invested in it. The names of these two ETFs are the Vanguard Developed World ETF or VHVG and the Vanguard Emerging Markets ETF or VFEG. Now, the reason I put these two together is because they go hand in hand and offer exposure to the whole world market again, but give you control over the weighting you can make for yourself to the emerging markets or developed markets. The developed markets being the developed world like America and Europe, with emerging markets being weighted towards China and India. The performance for Developing Markets Fund is 19.26% over the past year, and in roughly the past 4 years up a whopping 66%. Meanwhile, the emerging markets sits at about 9% return for the past year. It's worth noting that the weighting you want to devote to these ETFs is up to you. But personally, I would match the weighting similar to the all-world ETF that we talked about earlier, so 90% in the developed world ETF and 10% in the emerging markets ETF. The fees offered by the ETFs are 0.12% for the developed market fund and 0.22% for the emerging market fund, and at a weighting of 90% in VHVG and 10% in VFEG, you would actually achieve lower fees overall than the all-world ETF that we mentioned earlier, coming in at around about 0.13%. I would personally say that these two ETFs are for investors that want to achieve greater diversification and control over their investments than the all-world ETF gives you. You can change the weighting to suit your needs or personal convictions. If you think China will become a powerful economy to rival America, you can weight this one towards the emerging markets if you so choose. Additionally, this offers lower overall fees than VWRL, so if you want to keep those costs down even lower, maybe this joint way of doing things is the way to go. Finally, we get to the last fund. So sometimes the best returns are from the simplest and most obvious of places. Overly complicated ETFs with actively managed replication more often than not underperform and overcharge on fees. That's why the last and obvious choice is VUSA, or the Vanguard S&P 500 UCITS ETF, aiming to replicate the market index of the top 500 companies in America. This is the index that everyone in the world of investing is trying to beat, and you can own it at the low fees offered by Vanguard on Trading 212 of just over 0.07%, which is the lowest of the bunch offered here in the UK and is actually very hard to beat for fees. It doesn't have the same level of diversification that the other options do, and is made up of 100% of North American stocks. The weighting by industry is heavily towards tech. As we mentioned earlier, it's sitting around 29.6%, 13% towards financials, 12% towards healthcare. If you own this one, 7% of your money is held with Microsoft, over 5% with Apple, 5% with Nvidia, and so on. These are the best and most innovative companies in the world, and is overall a lot less risky than investing in individual companies that may suddenly have a poor year and drop in share price. Now, the overall performance of this one is what makes it shine past the rest. It has the best history of producing reliable and tested returns. From 2015 to today, so over 9 years or so, it's up 215%. That blows the rest of the funds out of the water in terms of growth. So that's the three best options in my opinion. Now, this is all subjective, and I recommend the first all-world ETF for investors that want an easy life, with slightly higher fees than the rest, but gain a foothold in the world economy without being entirely 100% focused on America. I don't think as an investor you can dismiss American stocks as a whole. They're simply too profitable, however they might not always be the case, and VWRL offers the best of both worlds in the simplest of ways. Then we have the developed and emerging markets ETFs, and as I said before, this is for slightly more active investors that want more control, with relatively less overall fees compared to VWRL and even more diversification, investing in over 4,000 stocks. It really doesn't get more diversified than that. I would consider this still fairly simple, only investing in 2 ETFs instead of a bunch of random stocks, and you still have control over the weighting for the portfolio in general. Finally, we have the simplest and arguably the best returning one, the S&P 500. Now, it may seem a cop-out to include one that everyone chooses to invest in, but I couldn't make a video on the best ETFs on Trading 212 without it. VUSA's returns speak for itself, with the lowest overall costs of the bunch, and is still diversified, just majorly focused in America. I would say this still lends itself towards the investor that wants to buy and forget, but does so with the main concept that America will continue to demonstrate its dominance in the stock market and keep innovating as it has for the past 20-30 years or so. Whichever one you choose, best of luck with your investing, and I'll catch you in the next one.